welcome to this training entitled Creating Passive Income. Let's review that definition. The definition of wealth or retirement is the accumulation of sufficient assets. You get a pile of assets that may include stocks, real estate, could be gold and silver coins. It doesn't really matter what it is, but it's an accumulation of assets that will generate that passive income that allows us to maintain a lifestyle based on what we've chosen and what we've accumulated. And so we're going to get into this in just a little bit more detail today. Now, most businesses use two tools that are accounting tools, if you will, bookkeeping tools. And those are a balance sheet and a profit and loss statement. And these two tools combined tell the business owner how to make decisions, financial decisions, that'll be wise and lead to the profitability of the company. And too often, I believe that families don't take the same kind of an attitude, and they really should. You see, isn't in fact the purpose of the family business or the business that is that of being a family to create a profit so that someday you can retire? And so there are similarities, but we don't usually correlate the two together. So I'm suggesting that families operate much like a business. All right, so let's take a look at these two. Balance sheet is a document or an accounting of the businesses, or in this case we're going to say the family's assets and their liabilities. And really this is a fairly simple formula. You add up the assets, and assets can be all of their personal belongings, household goods, cars, stocks, business ownership, real estate, whatever it may be, and you add up all the liabilities or generate a list of all the liabilities. Now, liabilities are things like a mortgage, credit card debt, any debts or obligations that the family is carrying at any given time. And so the formula is very simple. You take the assets, subtract the liabilities, and what you get is the net worth. Now that can be a negative or a positive. And I'd like to just pause and discuss that for just a second. You see, there's a difference between being in debt and having debt, okay? If you have debt, it means that you have liabilities on your balance sheet. If you're in debt, that means that your assets minus your liabilities is a negative number. That means that overall you're in debt. And I think it's really important to understand the difference, because it's not necessarily bad to have debt, but you don't want to be in debt, because sometimes the way to leverage and to increase your assets is by using debt. Say, take a piece of real estate, for example. You are able to buy a $100,000 piece of real estate with only $5,000 of your own money, and you use the debt to leverage that. You borrow money to leverage your purchasing power. Okay, so that's the balance sheet. Let's take a look at the profit and loss now, and that is comprised of, once again, two categories: income, all sources of income. From a job, from a business, from investments, from Social Security. It doesn't matter what it is. Any kind of income goes in that category. And then on the other side of the ledger, we have expenses. That could be utilities and, of course, payments on debt and lifestyle expenses. All the money that goes out over a monthly basis. Now, the balance sheet is generally calculated quarterly, sometimes monthly, but quarterly, and certainly annually, and you can track and watch the progress on your balance sheet. A profit and loss statement, especially with a family, ought to be looked at and addressed on a monthly basis at the very minimum, possibly even more often than that. So the formula here again is very simple. You take the income and you subtract your expenses, and that tells you what your profit or loss is. Obviously, if your income is greater than expenses, you have a profit at the end of the month. And then, of course, vice versa. Now, here's the issue that I think is important. We certainly want to, as a family, have a profit. But I'm going to tell you that far too many families in this country are running on a negative. And what that does, when you're running on a negative, then that increases your liabilities, because most of the time what's happening is that they're going into debt to make up the difference. And generally that's because their lifestyle is greater than what their income will support. And then that's another subject. We're just really talking about the general issues here. So we've got the balance sheet and the profit and loss. Now, we have two phases in our lifetime as it applies to the accumulation of assets and income and so forth. The first is the accumulation phase. That's the phase from when we become an adult and we start to earn money for our efforts. And over time, we're going to hopefully have an accumulation of successive months that we have a profit. Now, as that happens, in order to get passive income, we need to take that profit and use it to purchase or to generate assets, to increase the asset base. Remember, we said that the definition was to have our assets generate a passive income. So all during the accumulation phase, this is the process. We're building assets from our profit. All right, then we pass from the accumulation phase into the distribution phase. And at that point, those assets now need to be generating our income. And now you can see that there's a lot more that could be talked about this, and that is how to balance assets and liabilities, how to balance your income expenses. And we have all the tools to do this very kind of thing. And I think it's important for you and for the families that you work with to understand this simple little diagram, because this is what, if more families understood this, we would have more families having a profit at the end of every month and more families building their assets faster than their liabilities. Liabilities would become leverage tools to use to gain assets, and that there wouldn't be a fear of the inappropriate kinds of liabilities. And in another discussion, we'll talk about what are appropriate liabilities and what are not. But for this conversation, this simple little diagram is important for you to understand. Now, you don't necessarily have to spring this on a family the minute you get a chance to talk to them. In fact, you'll notice that in our presentation that we give to the families, we don't go into this detail. We simply define passive income as we did at the beginning of this session, and we leave it at that. But there will be a time when it might be valuable to work with the family to explain this diagram and help them to understand this. So this is creating passive income.